The next question is E7.12. Presented below is information related to Stanford SA. So there are 5 dates, okay, with each of the different transactions regarding receivables. So we need to prepare all necessary entries in general journal form for Stanford SA. So we'll start with July 1st. Stanford SA sold to Leckler Co. merchandise having a sales price of 10,000 with terms 2 over 10 net 60. So Stanford records its sales and receivables net. Yeah, remember if it's net, so you need to record the receivables and the sales with the amount already minus with the sales discount, sorry, the cash discount. Yeah, so July 1st, debit accounts receivable like the co credit sales. So 9,800, it is from 10,000 minus 2% of 10,000. So directly you record 9,800 because under net method. And then July 5th, accounts receivable of 12,000 gross are affected with Rothschild Credit Corp without guarantee at a financing charge of 9%. Cash is received for the proceeds. Collections are handled by the finance companies. Discounts were all past the discount period. So the company factored its receivables, okay, without guarantee, so without recourse, yeah, at a financing charge of 9%. So there is no percentage for the factoring firm to retain some money from for the Sanford SA company. Okay, so we can just record directly uh, debit cash, debit loss on sale of receivables, credit accounts receivable. So the accounts receivable will be 12,000. The loss on sale will be 9% of the receivable sold, so 1,080. And then the cash is 10,920. So there is no yield from the factoring firm because there is no percentage of that retainment. And then July 9, Pacific accounts receivable of 9,000 are pledged to Radar Credit Corp as security for a loan of 6,000 at a finance charge of 6% of the amount of the loan. The finance company will make the collections. All the accounts receivable are past the discount period. So this is secured borrowing. Yeah, this is secured borrowing. Okay, so you use your accounts receivable as your pledge to get a loan. Yeah, so you can just record it debit cash, debit interest expense, credit notes payable. Yeah, so notes payable is what you'll lend, 6,000. The interest expense will be the 6%, the finance charge of the notes payable, 360. So what you will get from the loan is only 5,650. And then uh December 29, Lechner Co. notified Stanford that it is bankrupt and will pay only 10% of its account. Give the entry to write off the uncollectible balance using the allowance method. Note: first record the increase in the receivables on July 11 when the discount period passed. Yeah, so because we record it using net method, okay, we need to bring it back to the whole 10,000 because Lechler fails to get the discount. Yeah, so we need to make the uh, journal entries first to increase the accounts receivable to 10,000. So debit accounts receivable like the go credit sales discount for faded. Yeah, so 200. Yeah, that will be the discount that like the fails to uh, get. And then we will just write off the accounts receivable of 9,000 because uh, Sanford only managed to get 10% of the accounts receivable. Yeah, so the rest of 90% will be written off. Okay, so debit allows for that for accounts, credit accounts receivable, let the code 9,000. And then we record what we can get. Okay, so debit cash, credit accounts receivable, let go 1,000. Yeah, which is 10% of the 10,000. And then December 31st, Sanford conducts an individual assessment of a note receivable with a carrying value of 350,000. Sandport determines the present value of the note is 275,000. So, uh, the carrying value is the book value, yeah, the other name. So the 350,000 is the book value that Sanford has already recorded. However, in the end of the year, when Sanford tries to calculate the present value of the note, it is only 275,000. Yeah, so remember the conservatism. Okay, we must choose the method that will not, yeah, or least likely to overstate net income and asset. Yeah, so we need to uh, lower our carrying amount of notes receivable. Yeah, because in the recent situation it is only 275. Yeah, so in the reality, okay, we just can get this 275, not 350. Yeah, so we need to make an adjustment. Yeah, so the adjustment will be debit bad debt expense. So because we cannot, yeah, we cannot get the whole 350,000, so it will be considered as bad debt. Okay, and then uh credit allowance for doubtful accounts. So once again, because this is still an estimate, yeah, this 275,000 is still an estimate. Yeah, so we just estimate it under allowance for doubtful accounts. Therefore, in the statement of financial position, okay, we will present the notes receivable with the most realistic amount rather than put the 350,000. Yeah, so that will be the last uh, journal entry for the account.